everybody. My name is Louis Wieland, and for the last 30 years, I have published the official relocation guides on Atlanta that are distributed by the First Multiple Listing Service of Atlanta. The magazines are distributed under the auspices of the First Multiple Listing Service. They are available in all of the First Multiple Listing Service stores for agents to pick up for distribution to their clients. They're also in all of the real estate brokerage firms in town for the benefit of agents to have and use to share with their clients who are looking to buy or sell residential or commercial real estate. They're also on the First Multiple Listing Service of Atlanta website, fmls.com. You have to be a real estate agent to access that website, but they're also on my website, atlantacommunityprofiles.com. We also send them out to all the agents and through email. And so basically there are, the FMLS, or First Multiple Listing Service, is the third largest multiple listing service in the United States. And they serve agents not only in Georgia, but also in Tennessee, Florida, and just added Miami, as a matter of fact, to their service area. They're now representing all the agents in Miami. So we have Tennessee, Florida, Georgia, and Alabama as well. So altogether, I think now probably around 70,000 agents have access to FMLS. I'm also a commercial agent with KW Commercial. And if I can help you with any of your commercial real estate needs, please let me know. My email is louwieland@kw.com. By the way, we do have magazines. We have 4 publications right now, one for the metro area, one for North Fulton, one for Cobb, and one for Gwinnett. And they are, like I said, all available in all the real estate brokerage firms and at the First Multiple Listing Service store. Every week or so, we interview community leaders, people who are contributing to the well-being of our community and serving clients who are interested in buying and selling residential and commercial real estate. And the other day, a friend of mine at KW Commercial interviewed Charlie Brown, who's on our show today, and I thought it was a phenomenal interview and something that I wanted to share with my listeners. So, Charlie, welcome to our show.
Thank you. Great to be here.
Charlie Brown, CEO, Signature Bank of Georgia. One of the things that is kind of a critical factor in the real estate market is that, which Charlie mentioned in the presentation at a KW commercial meeting, was that $1.5 trillion in commercial loans are coming due in the next 3 years. And also he mentioned that there were 3 recent bank failures. So this is a very interesting time that we're living in and about ready to make some changes. Charlie has been CEO of community banks for 25 years. He started 2 banks. He's even purchased and sold a bank. He's done mergers and acquisitions of banks. He spent 6 years as one of the 14 bankers chosen to represent the 5,000 community banks across the country. And he served on the advisory committee of the FDIC Community Bank Board of Directors. He's graduated from Ohio State, but we won't hold that against him. He's a good guy, nevertheless. Signature Bank has been in Sandy Springs for now 17 years. He's the new CEO of Signature Bank. He's only been there 7 months and starting to get out and meet people. And a friend of mine at KW Commercial invited him to speak at our KW Commercial meeting, and that's how I got to know him. But his time at the FDIC on the board of advisory committee for the board is quite impressive. and that he was chosen to be on that board of directors. He served there, as I mentioned, 6 years, so it's quite a great background and somebody who can really help us understand the ins and outs of the situation now and where we're going. So, Charlie, the first thing I would like to ask you is, what is a community bank? Why should we deal with a community bank? And what is the difference between a community bank and banks like Wells Fargo and Chase, et cetera? And
I'm sure that's a great question. Really, the primary difference is that we're locally owned and operated. We have a little over 300 shareholders, 60 of which I just brought to the table recently. So our shareholders are here in the community. They own the bank. They're people just like yourself that invested in the bank. So we're locally owned and operated. And then the other, as a result of that, we're a smaller bank. We only have about 35 employees. So we're about the same size of business as many of the businesses we lend to. As a result, we're very nimble and we can customize. So the reason people tend to come to us is they want to know their banker. They want to speak to the person that's making the decisions, not to, let's say, a lender who then has to ship a package off to a committee in another state or another city. So very, very hands-on. Again, very similar to the types of businesses that we bank. We are that same size and flavor.
are your services limited because of being a community bank, or do you still offer commercial lending as well as residential and personal, or how are your services different?
That's a great question. The community bank charter itself does not limit it, but we have focused our services on businesses. So we do not try to out-consumer the Wells Fargos of the world. We have targeted almost a boutique bank, if you will, towards commercial and commercial real estate investors.
Okay, so Charlie has a great presentation that he gave at a KW commercial meeting, and it addresses the reset of mortgages coming and the fact that at $1.5 trillion is going to be reset in the next 3 years. And he's got a presentation that addresses the implications of that and how we can prepare to take advantage potentially and prevent having a problem. So pros and cons, what we can do and what we can prevent ourselves from having problems with. So, Charlie, take it away. It's something that I think everybody will greatly benefit from and enjoy. So let me turn it over to you at this time.
Okay, I'm going to share my screen and launch this PowerPoint. So bear with me while it comes up. And there we go. Start from beginning. Okay, so I'm going to move through this very quickly. This PowerPoint was really designed for about double the time in the Keller Williams meeting. But as you referenced, the 1.5 trillion in commercial loans coming due in the next 3 years, the question to me was, how will the banks deal with these loans? First and foremost, the banks are going to curtail lending. We've already seen that. Bloomberg reports there's more of a credit squeeze than a credit crunch right now, which I think is good. I will tell you that there's one local regional bank that, and when I say local regional, that's a multi-billion-dollar bank that has not done any new lending other than for existing clients in the last 6 months. So they've already curtailed. And there's a second regional bank in this market, not based out of here, but they have a presence in the market. They've moved their lenders all over to retaining deposits and providing them incentive to retain deposits. So they're not doing any additional lending. Recently, the Atlanta Business Journal just stated last week that Fifth Third Bank has announced that it's doing no more office lending. So the curtailing is the very first move to answer the question is how they're going to deal with all these loans coming due. The second one is the cash flow. Most of us know that banks are looking for cash flow for at least 3 years. And if they don't have the cash flow for the last 3 years, the banks would try to exit, not necessarily foreclose right away, but they first of all will look at if and go through a non-renewal period. As some of these loans come due, both in the private sector as well as the banking sector, they'll effectively notify the borrowers, we're not going to renew it, please move it to another lender. If that doesn't work, and if the cash flow isn't there, often you'll hear of banks deeming a loan in technical default. And while legally it certainly has some weight, not many banks during the crisis, let's say 2008, were successful declaring technical default and actually foreclosing on that basis. I was actually in a courtroom pursuing a loan that we had on a commercial basis. And there was another bank that was bringing a suit against a borrower under technical default. And I saw firsthand the judge throw that other case out because the borrower was still making payments. And so the judge sent them back to mediation saying, work something out. I've got other borrowers here that are actually missing payments. I don't want to deal with technical defaults right now. So although it can be very heavy-handed and not a pleasant experience to go through, that is typically a second move. The second or the third attempt, I call it second attempt here, may be a cash pay down. And I do have a very good friend of mine who's invested in a number of commercial real estate properties and some REITs, and he's already notified all of his friends that there may be capital calls coming where they're going to have to pump some money into their properties. The next item that the bank looks at is valuation. I think we all know commercial real estate, though, the valuation is tied to cash flow. But this will be the second attempt at non-renewal. They'll say that, okay, we are under collateralized. As a result, they want a cash pay down. So again, capital calls, or an attempt, a pledge to ask for a pledge of additional property or equity. This is a little difficult to do if you don't have common ownership between properties. But if they're individual entities or borrowers, they certainly could reach out to other properties where they have equity and shore up the collateral position. Again, I don't see a lot of foreclosures. Last time there's just too much carnage in 2008. The only winners were the healthy banks that were buying the failed banks, and there was some loss share agreement accounting that benefited them greatly. It is interesting to note, though, we had a San Francisco hotel that went back to the lenders on June 6th. That was being reported across the news, and an office building out there. So there are going to be some buildings, and there was another one just stated last week in Atlanta that went into foreclosure. So there are going to be some foreclosures. I just don't see it happen at the same level it did during 2008. Now, the other thing you'll hear a lot of, those of you in the commercial real estate industry, we hear about CRE buckets, commercial real estate buckets at lenders. And if you ever hear a lender say, we are filled up with a particular type of real estate, this is what they're referring to. In the banking reg, they give you guidance, the regulators do, that they want to see your commercial real estate no more than about 300% of the bank's capital. And keep in mind, and this is a rough way to look at it, but a bank has to keep capital on a 1 to 10 basis, meaning that for every $10 or $10 million in assets that it has to have at least $1 or $1 million in capital in those two comparisons. So if that was the case, let's say that you had $1 million in capital, we could only lend out $3 million, or again, you can convert that to billions in commercial real estate in total. The other limit or guidance they put out there is only 100% of capital in acquisition, development, and construction lending. So there's a 300% overall total of capital. So 3 times your capital you can lend into commercial real estate, but only 100% of that can be in commercial real estate development. This second item B here is really what got the industry in trouble in 2008. And the reason I shared this with a lot of you is the following. In 2021, so well after the last crisis, really only 25% of the banks out of over 4,500 were in excess 300% nationwide. I will tell you this is remarkable. Back in 2008, in fact, the bank I ran, and we never had any regulatory issues. We were very successful, and a lot of it was due to the fact we had so much capital, but we were as high as 700%. And many of the banks were at that level. But this is remarkable that the regulators have influenced the banking industry and brought them down. Only 25% were above 300%. So you can see only 422 banks, or about 10% of the nationwide banks, had exceeded either the 100% acquisition development lending or the 300% goal meaning or both. So again, very few banks that went above these guidance limits. That doesn't mean that they're in trouble. It doesn't mean that they've done something wrong. It just simply is stating that, and I'm sharing this because commercial real estate metrics are down considerably. In residential pricing, as we know, is holding up at this time. It's not down the 50% that it was in 2008. In Georgia, I'm not going to dwell on this because we have to cut this presentation back a little bit, but you can see that there are very few banks. 8% of all Georgia banks are above the 300%. So certainly even lower here in Georgia, and 16% exceed the acquisition development lending. Again, very low in the state of Georgia, so it might even fare better than the overall country. A second question asked of me by KW Commercial was, office buildings been hit particularly hard with remote work and layoffs. Do you see a large number of loan defaults in office and other sectors? Well, I will say this, private equity, I do have some private equity investors in the bank, and I was at a conference recently. As soon as I got back, when they were talking to, I was hearing about office exposure and what have you, I had a call waiting for me, and my voicemail was from one of our investors wanting to know what our office exposure was. And I'll tell you, it was somewhere around 8 to 10% of our capital, so not very much. But the point to that is the analysts are tracking how much office exposure each bank has, and they've already reflected this in the bank stock. So I share this because I think that the leverage levels also, so not only has all this been taken into account at banks as far as the risk, but the leverage levels seem to be much less than in the past. And in 2008, I saw lending on offices at as high as 85% on the cost or the value. It appears that most of the lending over the last few years has been done more at the 70 to 75% range. So again, there's a little more safety built into the system. And we all know that in addition to that, this leverage has been driven down by the compression between the cap rate and the loan rates, meaning that leverage does not necessarily result in the same leverage return because both rates are so close. There used to be a bigger gap between your cap rate and your loan rate, and that is compressed. As a result, there's less of a tendency to leverage the properties up by the borrowers themselves. That in job numbers continue to improve. Unemployment is down. There's even some talk about job hoarding where some industries are not exhibiting huge layoffs because they know how hard it was to get staff during COVID. The other thing I think will help the office industry, again, we'll see some foreclosures, but I think it will be muted, especially compared to anything that resembles 2008. You've got these return to work mandates. This will offset some of the further downside risk. Most companies have moved at least to a 4-day work week, where it was much less before. That said, 1 out of 3 people that were surveyed recently stated that if they were asked to come back to work, they would resign. Again, I think this is why you don't see a lot of layoffs. There are a few, but nowhere near what was predicted 6 and 9 months ago. They think there'll be some natural attrition as some people don't want to go back to the office full time. There's a local high-tech high-tech company that just issued return to work. If anything, they may need more office space, not less. So that all being said, in the high rise, the metro markets that will still take the brunt of it. We've read in the last couple of weeks, again, with the local business journal, that there have been a number of large companies here in Atlanta, NCR being one of them, that is subleasing out about half of its space. McKinsey & Company, based out of New York, but has a satellite office here, is subleasing out a lot of its space. So we won't really see what happens from a performance standpoint on some of these buildings until they get to the end of those leases. So the subleasing is kind of a question mark. Again, in San Francisco, there was some mention of a bank going dark and going into foreclosure. The next question was, what are your predictions for interest rates and for commercial loans going forward? I'm going to kind of blow through this. This is a little dated because this was a few weeks ago. We know that the Fed took a pause in July. We are now hearing that there's probably a pretty good chance we'll get at least 1, still even 2 more rate hikes before year end. So, I think that seems reasonable. I do disagree with a few of the economists. I think the Fed will not start decreasing rates till well into next year, third, fourth quarter, if at all. But keep in mind, and this is very interesting, we are in a strange time period here. if you look at June of 2021, this bottom is kind of a normal yield curve back in 2021. It increases, which means you should get more rates or pay more the longer you want to borrow or the longer you want to invest. Time value of money. We were all taught that in college. But look what happened in June of 22. This started to flatten out quite a bit. And now we have an inverted yield curve. In fact, one of the largest inverted yield curves in, I think, over 40 years, meaning that in theory, you would actually pay higher rates. Whether you're an investor, you should earn higher rates for shorter term money than if you tied your money up for 7 years. And so you have a lot of people out here investing in treasuries in the 1 month to 3 month range versus going out into the 3 year where you actually earn less. The same applies for loans. Believe it or not, a shorter term loan would have a higher rate if tied to the current treasury yield curve versus if you went out a little further out on the curve. So this brings us into some really unusual times as far as interest rates. This is just a quick slide by a local economist, Rajiv Dhawan, Director of Economic Forecasting Center at Georgia State University, in a presentation that he gave to a credit group associated with the Georgia Bankers Association. So again, I think most of us see that there'll be an increase in interest rates. He was talking about a decline next year. Again, I don't see that happening quite as soon as maybe he would expect. He was thinking December this year. I think it'll probably be well into next year. Here's some quick math as to what happens with interest rates. Fed funds in May of 2022 were 0.77. In June, they're up to 5.06. So it went up by 4.29% or up 429 basis points. That's your short side of the yield curve. The 5-year treasury, which is what most of our commercial real estate loans are fixed to, went from 2.81 only up to 3.82 over that same time period, May to June. This is May to June. It only went up by 1.01%, the total increase. So it's interesting. If you look at the CMT, the constant maturity treasury, changes about 25% of whatever Fed funds do. So you'd see it only moved up 1.01. Fed funds went up by 4.29. So if we had 2 more Fed hikes, and I'm answering the question, what do we think is going to happen with rates? If they were to move up by 50 basis points, half a point, that means the result in the 5-year treasury would only go up from 3.82% to maybe 3.95 or 4%. Again, if you're lending at the 5-year treasury plus 3%, which is a pretty typical margin, give or take, that would move your interest rates up from 6.82% right now to maybe 6.95%. Now, there is another caveat here, and that is banks' deposits are getting much more expensive. There's more competition. There's been a ramp up. In fact, it's the headline of American Bankers magazine is the funding crunch. And as a result, I'll tell you, most loans will be done right around the 7% and slightly above now. So even though we might see a couple rate increases, it's not going to be a percentage point for percentage point increase in interest rates. There is a rule that's being proposed for SIFI banks. These are statistically, systemically important financial institutions. That's what SIFI stands for. So these are the biggest of the biggest, the Chase banks, the Bank of Americas. But they keep in mind, even if they move them up in capital, the SIFI banks are already 30% less capitalized than my bank, as an example. So if you move them up 20%, which is what the proposal is that's coming out, it just gets them a little bit closer. They still don't have to be as highly capitalized as a community bank. So again, if that could push interest rates up a little bit, because to get the same level of return on equity, if the banks have to hold more capital, they would have to raise their interest rates. I'm going to skip through a little bit more of this. That was talking about loan pricing, just proving out the fact that if a bank has to have more capital, it's going to have to charge more on its rates. The other question that came to me, are we likely to see many bank failures, and how will the FDIC react? There were 3 bank failures recently. I want to correct my bio. We are Signature Bank of Georgia, not just Signature Bank. I had to say that because one of the failures was Signature Bank of New York. And keep in mind, these were not credit-based failures recently. This had everything to do with other comprehensive income, their unrealized losses in the bonds and investments. And I will tell you, the other failure had a lot to do with private equity and cryptocurrency. Very, very different than last time we went through any kind of a banking crisis. Not CRE driven, not real estate driven, not credit driven, but this was all about their investments because of that inverted yield curve I showed you earlier. So I don't think we're going to see the same level. And there is some discussion about the FDIC starting to guarantee all deposits, not just up to $250,000. I'm going to skip through this as an accounting overview, but it explains that some of these banks took on the different accounting methods to account for their losses in their bond portfolio. Some of it is not as evident as others. But you'll see here some of the Georgia statistics. We have 4 banks, which is not many, that exceed 75, their losses in their bond portfolio exceed 75% of capital. And then we have 36 and 36 also in the 25 to 50%. So most of the banks, their losses in the bond portfolio are anywhere between 10 and 50% of the capital. So again, that's good news. I don't think you're going to see a lot of failures in the state of Georgia because of these bond losses that were brought up. So again, don't see that playing a big role going forward. One of the other questions that was asked, and Louis referenced it early on, what's the difference between a community bank? And then specifically it was asking me what made Signature Bank of Georgia different than the other banks. Well, we have now capital 45% higher than our peer group, and capital is king. That's what separates one bank from the next. Again, this has a lot to do with the fact that I came on board about 7 months ago and I brought in 60 more local investors to bolster the capital. Again, office space here is only 10% of our portfolio. And our other comprehensive loss in our bond portfolio is only less than 10% of our capital, which is very low compared to some of the other banks in the state of Georgia. So there's less risk at this institution. As a result, we're smaller and we're more nimble. And that seems to be the word of the day. Being nimble counts for even, I think counts now more than big plans and strategic plans. Another aspect of what we're about is we are the top 10 SBA lender in the state, so we do use SBA loans. And we are issuing preferred property letters to commercial brokers. If someone brings a property to us and we'll take a look at the property, see if it's something we want to lend on, and then we'll issue a letter saying we're very interested in lending on this property, so the broker can use that as a collateral piece to market that property to other parties. And on top of all that, we've adopted a go and grow strategy. I've increased the lending team here by 5-fold since I came on board as part of this go and grow strategy. And then we brought in the additional capital. So we're actually out there pursuing 6 and 7 more lenders as we speak. So there was a question as to what our loan limit was. Our legal loan limit is now $7 million. We'll go up to $14 million, but we have to use a participant bank. And at the end of the day, I would say the biggest differential is the fact that we are fortunate to have raised capital. We raised about $7 million more, 30% more capital than we had before. And that separates Signature Bank of Georgia from the other institutions. So with that, I'm going to stop sharing my screen and turn it over to you. And if there's any follow-up questions that you have, we have time, I'd be happy to address them.
Okay, so thank you very much. That was very helpful. We have a lot of residential agents watching this show, and they may not be familiar with some of the terms and the implications of this. And tell me what define the Treasury yield curve for the benefit of some of those people.
Sure. So the Treasury yield curve is when the government issues a new Treasury, so it issues debt to fund its operations, it issues them in different time periods, just like CDs. So the 90-day, 1 year, 2 year, 3 year, 4 year, 5 year. And what the yield curve is saying is that when the government issues debt, and a lot of it depends on what the investment community is demanding as a return, the yield curve is just simply that. It's saying at what percentage rate did the government have to issue debt to get someone to buy its debt. And the yield curve simply in the past, when it's upward sloping, which is more normal, we're all taught this in college. If you're going to tie your money up, you ought to get paid more for tying your money up. So normally you might have a 90-day treasury would be at 1%. And then let's say a 10-year treasury that the government's issuing would be at, let's say, 3%. Well, that's more normal, an upward sloping yield curve that you expect to get more on your investment and you expect to pay more on a loan if it's a longer term loan. What's happened is that with all the rate increases in the short end of the yield curve and what the Federal Reserve has done is it's flipped it. Now all of a sudden, the short-term treasuries are significantly higher than long-term treasuries. Not only did it go flat in 2022, but it went inverted. This is a very, very unique time. I was with some folks this weekend who sold their business and did relatively well. And instead of investing even in the stock market, he's investing in 90-day treasuries because they're almost 4 and 5% in the 90-day to 1 year treasury mark. You can do better in the shorter term treasuries than you can going out 4 and 5 years. Again, unheard of, I think in the last 40 years. So this is impacting businesses. I'll give you an example. So we right now are paying 5% on checking accounts, not money markets, not CDs, but a checking account. Someone can open as a consumer or a business. We're paying them 5% to have their money on deposit here, and we're lending it back out at only 7%. That's a 2% margin. That's about half the margin that banks typically want to operate. They want to operate at about a 4% margin. The point to sharing all that is that while I don't think the Treasury moves, the Federal Reserve moves are going to bounce rates up a whole lot further, there is some upward pressure on banks from a funding standpoint on the deposit side because of this inverted yield curve that is going to push loan rates up. So most of the loans that we're doing right now, if you were to come in today, we're probably in the 7% plus range. And honestly, about 2 months ago, we were sub 7. We were below 7%. But this pressure from deposit costs on just about the entire banking industry is going to push rates up. There are a few banks that have pulled back, as I mentioned, on lending. They won't have the same pressure that we will because we're still out there going and growing. We're still out there lending. I'm adding to the team. So those are a few that had dynamics. The residential world is very different right now. They called it an anomaly this morning on Bloomberg because you have people that don't want to put their house up for sale because they have to refinance the new house or finance the new house at higher rates, significantly higher 30-year fixed rate loans, which are tied to the 10-year treasury, even though it's inverted than what they had before. So the residential world is really working entirely different than what the commercial world seems to be. So we could probably spend an hour on that topic. And certainly the commercial world better than I do.
The interest rate is a lot higher on a commercial loan than on a residential loan. Why is that?
Liquidity. So a residential loan, more often than not, is a package through Fannie Mae and Freddie Mac, which is a government-sponsored enterprise called the GSE, and it can be sold into a secondary market. It can be split up, the different cash flow streams. So when a bank makes a residential loan, it really becomes like a bond to it. It can package it up and sell it off for liquidity right away. That is not the case on commercial real estate loans. Most commercial real estate loans that banks make, and I'm talking about the smaller banks, they have to hold them on the books. So they have to live with that interest rate risk that they've just created. So because of the lack of liquidity that they have on that loan, there's a higher credit risk premium that's charged on the commercial real estate component itself. And as you know, commercial real estate loans, the rates are negotiated one deal at a time between the borrower and the banker. Whereas if residential loans have consumer, if it's a package that has to all fit in to go into a secondary market, so everybody gets the same rate. The only thing that is varied is by the credit risk of the borrower themselves, but it's not negotiated between the lender and the borrower. That there's consumer regulations that are in place. Whereas if on the commercial side, it's more business owner to banker, where they're negotiated based on the risk and what the two parties can find an equilibrium.
So, Charlie, in layman's terms, the reset that will be coming available to us is going to result in a lot of investors having to refinance their loans
Right.
at a higher rate of interest, and therefore a lot higher mortgage rate on their loan.
Right.
So already I'm hearing of people who are saying, I need to sell this property because
Yep.
I can't make a profit at that rate. So there will be more investment properties coming on the market over the next year or so. What will be the effect of that on the prices of investment real estate? Would you say they will come down a lot or what?
I think, I wouldn't use the word a lot, but I think certainly I'm a big believer in supply demand. When you have a higher supply that might be brought to market than there is a demand, I think the prices will come down. And quite candidly, they probably need to a little anyway because of that compression between the cap rates, which is what an investor earns on their property, and the interest rates on loans. Those are almost too close right now. We need a little bit bigger spread. I'll give you an example. I had a referral from a commercial realtor a week or so ago, and they were looking at a property. If they paid X dollars for it, she said, how much can I borrow against the value of the property? And it wasn't because I wanted to lend less in value. It was because I had to come up with a number that the property would cash flow at. And said another way, the seller of the property was asking so much for the property that it would only support debt of about 33%, not 60%, not 75, not 85, but 33%. So in that case, what she realized, the buyer, was that she'd be overpaying for that property. So they're going to have to go in and offer substantially less on that so she can get a bigger cap rate, and it will make more sense as a percentage of what she pays. Then I can lend 65, 75%. So I do see an adjustment. The demand, the cap rates have got to go up. And the only way that's going to work is if property values are adjusted downward on the sales side. So I do see some decreases in overall values. Again, not to the point where we're all rushing into foreclosure court. I don't see that happening like what took place back in 2008.
So cap rates have come down in the last couple of years. And
Which is this strangest anomaly, because here we are, Fed keep pushing rates up. You'd think that push the rates up, but look at that yield curve. Cap rates are just the longer part of the yield curve. It's a longer return on investment, and they've come down while interest rates are being pushed up. Again, I think you're going to see some cap rates come up a little bit.
I mean, today I was talking to some people in Athens who are trying to sell me some apartments for a 4.5 cap, and 3 years ago the cap was 8.
Yeah,
it's a huge change.
I don't know how does that work. If I'm paying you 5%, if you just open a checking account here, why would you invest and take all the risk associated with commercial real estate 4.5%? I mean, those two, one's FDIC insured, the other's not insured by anyone. I mean, that doesn't mesh up. So again, I think there'll have to be some price adjustments to move those cap rates up.
So the price adjustments will be coming down, and that's a big difference in cap rate. So that would be a big difference in the price reduction too, potentially.
Right.
Do you see any particular areas of the state that are represent more potential or than others? I
don't know. We stick primarily to the greater Atlanta MSA. So we really kind of focus on it. I'm not I don't track the rest of the state per se.
Lumpkin County and Dawson County, it was an article somewhere recently, it might have been I can't remember what it was, but are poised for phenomenal growth because of unemployment and crime, et cetera, are down, and there's a lot of people moving up that way to be away from town.
Yeah. No, I understand that, and I believe that.
So what about the down payment? Now, the people are having to put more money down, right, now on commercial investing. Is that right?
Well, and again, that's not driven by, the bank doesn't have, it's driven by the cash flow of the property. It's not driven by the fact that the bank doesn't want to lend above X percent, requiring another percent as a percent down. It's the cash flow. The bank is backing into how much it's going to lend on the property, trying to get to a 1.25 debt coverage ratio, meaning that the net operating income of that property will cover the debt by 1.25 times. So that's really the starting place. I've been doing a lot of, you don't do pre-qualifications on the commercial real estate front, but you do take a look at the property and say, okay, how much debt could this property support and still hit the bank's ratios on a debt coverage ratio? And that was the example I gave earlier. The property that was brought to me back in the day, we would have said, oh, we'll lend it 75%. This was a multi-tenant townhomes, 8 units that were brought to me. But again, with the asking price at the level they were asking, the most that property would support was about 33% debt. So what has to happen there is the borrower's going to go back and say, well, I'm not going to pay you this. I'm going to pay you this, since it can only support this debt level. So as a percentage, it might go up to, since this is the debt level, this was the asking price, the debt level is kind of fixed based on the cash flow. So they're just going to have to lower that price to the point where it makes more sense. And that gap would be the down payment. So again, you're going to see, it's going to be the hardest question to answer. And that is, what level of financing will the bank offer on this particular property? They won't know until they get into the numbers, the cash flow, and how strong and stable the cash flow are. So it's going to be a little bit of wild, wild west on a deal by deal basis.
A lot of people watching this represent investors, and particularly the darling of has been industrial and multifamily lately.
Right.
And for multifamily, the rents are going up a lot.
Right.
And do you take that into consideration in that 1.25 debt service ratio, or the potential for increased rent, or do you just do it on the basis of where it is now?
They do it based on where it is now. The banks, because banks look at, we have a limited percentage that we can make on it. It's the interest rate of the loan. So we aren't really betting on what we think can happen. That's really more for the investors to do. That's kind of their money, if you will, at risk. So banks tend to look at what it's been doing over the last 2 to 3 years, use more historical rents. You're not going to see a lot of banks. You move into the non-banking sector if you want to borrow or lend against projected rents, because it's just that it's projected. It may come to fruition. It may not. So that is. I looked at another deal recently where it's just trying to stabilize now, even though there's tremendous upside. That's where the buyer's benefit is, not so much the banker's benefit. So bankers do tend to look at things a little bit differently because its upside is limited to the percentage on the interest rate associated with the loan, and its downside obviously is limited all the way to zero theoretically.
So industrial versus multifamily?
Industrial's hot. We have more room in our buckets I was describing earlier in the industrial area than in the multifamily. We can kind of grow and go forever on the industrial side. I'm shocked at the levels that some industrial properties are selling for, from the standpoint they're selling for significantly more than it would cost to ever reproduce them. There seems to be a limited supply of properties and a high demand. And while if you listen again to the Federal Reserve and a lot of the economists that are out there, the manufacturing industry has kind of taken it on the chin. And despite that, it is still really moving along. And so the industrial side seems to be in pretty good shape. And I think it's going to be a hot area for some time to come.
That's great to know. Particularly in this area, we tend to be a high import state with the Savannah Port Authority, and that has a direct impact on that industry. What about land? Do you guys do anything with land or not?
We don't do a lot in land, and a lot of it was that other bucket I talked about earlier. So the regulators see land, if you will, especially if it's tied to a development loan, about 3 times riskier than other commercial real estate. That's why they have that bucket for other commercial real estate, 300% of capital, but land, they crush it down to 100% capital is the most that you can have in their eyes. So land is a little bit higher risk, and it is the thing that got most community banks in trouble during the 2008 debacle, if you will. So we have shied away from vacant land. It doesn't mean we don't have any. It just means it's very, very limited. And I still think most community banks are going to march to that drummer.
Charlie, how can people get a hold of you if they would like to come by and talk to you? Or
Sure. I give my cell phone number out. It is 470 470-799-9288. That's 470-799-9288. Or you can email me at cbrown@signaturebankga.com. Again, cbrown@signaturebankga.com. And the GA is because we're Signature Bank of Georgia.
And by the way, that is a key factor because if people Google Signature Bank,
Yeah.
they will be surprised at what Google says. Tell us about the difference between Signature Bank of Georgia and Signature Bank of whatever, other state or.
Well, there are actually 6 or 7 signature banks out there. None of them are related. So it was just a happenstance that bankers, I think, lack some imagination on our name. So we chose this similar name, but the names are always of a different state. So completely unrelated. Again, the Signature Bank of New York got into trouble with a completely different industry. It wasn't credit. It's kind of a fun story. I actually had to go to the CEO of Google because I was issuing capital. I was bringing in new investors right in the middle of the crisis with Signature Bank in New York, and Google's their news system was combining the news on both of our banks into one screen. So it pointed to their CEO as our CEO, their stock price is our stock price, but then our asset size is their asset size. So I literally had to put in a case with Google, and to their credit, in about 72 hours, they brought it all down and got it remixed. But not at all related to their signature banks of anything out there. Signature Bank of Georgia is independently owned and operated here in Sandy Springs in the Atlanta MSA.
Sandy Springs, you've been there for 17 years.
17 years the bank has, yes.
You're new to the bank, but not new to the industry by far. You've done quite an extremely impressive background there in the industry, and we definitely recognize your level of achievement in the industry. Well, thank you again, Charlie Brown, CEO, Signature Bank of Georgia. So if you want to Google it, make sure you say Signature Bank of Georgia, not just Signature Bank. Thank you very much for listening, and thank you, Charlie, for your wisdom and sharing some of your precious time with us.
Very welcome.
Thank you for
Very
listening,
welcome.
and have a nice day.
Okay, you too. Bye-bye.